Welcome back to another episode of Money Script Monday. My name is Gabriel Lindemann, and I'll be your host today. Today, we're going to be talking about EFC option number 3, using an IUL for college funding. With that being said, let's get started. I love IULs. IULs in college planning is the opportunity to put together a real financial plan. All the other options we talked about, using a MYGA option, whole life, or a MYGA, multi-year guaranteed options, were purely just on sheltering and long term. When we incorporate this plan, it's a true financial plan that does college funding, college planning, but more importantly, you can use that money for retirement planning. When we look at these statistics over a 20-year period, most of our policies have been averaging 7-8%. What's really good about that 7-8% is you're never digging yourself out of the hole. For example, if the market goes up, you get the pure growth. If it goes down, you just go flatline. So if market goes up like it did in 2007, 2008, 2009, it crashes. You don't go down 40%, you get a zero. Something we say in the industry is zero is our hero. And that is really, really true when the market's going down and you look at your report and you have a 0% return. On the flip side, 7-8% return over a 20-year period is fantastic. I know a lot of mutual funds out there want to show you 15, 20%. This is a conservative approach. This is what we would call the putter approach in a golf bag analogy. You have your drivers that are for your mutual funds. You have your clubs and your wedges for getting a little bit closer. Those could be from your, bonds with a little bit higher risk. This is your putter. Safe, predictable, 7-8% over a 20-year period. Now, everything has pros and cons. Everything is good and bad. So let's focus on that. Let's look at the pros right now. It has tax-free growth. That's phenomenal. It's the last time I checked, only muni bonds if you purchase them in your own state and a Roth IRA. This allows you to get all those same benefits. Tax-free distribution. That's the most important thing in the world. One of the best advisors in the industry, Doug Andrew, taught us all many years ago, would you rather pay taxes, if you were a farmer, would you rather pay taxes on the seeds or the harvest? Well, obviously the seeds, you want to pay on the smaller amount. And that's what we're going to be able to accomplish by using this type of portfolio in IUL with college planning. Principal protection. As I said before, if the market crashes, you don't crash with it. You get a zero. Zero is your hero. Low fees. Now, I know some advisors out there, and if you Google Susie Ortman or Dave Ramsey, they have opinions that this is very expensive. Well, we'll talk about that. But in reality, if structured correctly with the lowest death benefit possible right under the MEC guidelines, so that way it's not a modified endowment contract under the 7-pay rules, it's perfectly. In fact, over a 20-year period, the average cost is going to average anywhere from 1% to 1.5% if designed correctly. Now, this is an EFC play as well. Now, it's not solely EFC play because a lot of times families that have this money have a lot of higher income families, have a lot of extra income, so it might not be able to qualify for EFC. But if you are, it does work in that manner. And a full financial plan. There's many components to it. It's not sheltering assets. You're looking at rates of return. You're looking at arbitrage. It's my favorite plan because it has so much opportunities to help so many families out there. With that being said, though, there are some cons. I know everyone wants to say it's the greatest thing in the world, but it's not. Every family is different. Let's discuss one of the cons. Many people say it has high cost. Now let's go over that. In the first 10 years, they're front-loaded expenses. Very similar to a mortgage payment. What happens when you own property, you make a mortgage payment? For the first 10 to 15 years, most of your payment is going to taxes. You don't start deducting the principal until about 10 to 15 years. Same thing with this type of product. It's very high in the first 10 years, but it's reducing every year after about the 10th to 12th year. By the point after about 20 years, you're about 1%, 1.5%. And then after about 20 to 30 years, and many case designs are structured correctly, it's below 75 basis points. That's 0.75. So I would argue that 0.75 over a 20-year, 30-year period is probably the most cost-effective financial plan out there. Not including the fact that we get principal protection and it's a real college plan vehicle. Medical approval. As I said before with the MEC whole life, is that one of the drawbacks is you have to get approved through your health. If you have, a lot of disorders like heart disease, cancer, even uncontrolled diabetes, this might not be the plan for you. You're better off maybe looking at an annuity option or a MYGA option. That's why you want to work with a certified college planner to go over pros and cons of what's best for you. And lastly, you need to use about 5 years to let it grow. You want to let it cook so you can access your money. With that being said, you can get access to your money immediately, but you want to let it grow. You want to let that positive arbitrage. You want to get that 7-8%. So when you're up here, it has money accumulated and you'll be able to pull out that money tax-free. Now, accessing your cash, that's very important. As we said before, we use the comparisons of the Roth. Well, it's not a Roth when you look at the IRS codes, but it has similar distributions in the fact that when you pull out money out of it in the form of a loan, it comes out tax-free. Now, it is immediate access. So if you do have cash built up, let's say you do a large 1035 and it goes over there. Let's say day one you have $50,000 cash accumulation because of the 1035. You can access that cash 30 days after issue. What's very important about that, it does not show up on the FAFSA or private schools. That cash you borrow against it to pay school loans or whatever you need for school will not incur a 1099 distribution. Therefore, it does not get reported to FAFSA schools, but more importantly, those high-end profile schools we all want to get to. Death benefit protection. Now, we all know eventually we're all going to pass away. When we pass away, nobody knows. But when you do pass away, you're going to have the confidence that you're going to be able to leave a large legacy to protect your family. And if your children are still in college, that money can there to pay the difference of the college loans to make sure they'll be able to graduate and be safe. As I said before, every family is a little bit different. It'd be impossible for me to say, this is the best option for you without looking at your scenario. This is the benefit of working with a certified college financial planner. Because one, they're going to look at your full financial aid. Two, they're going to determine what school is the best fit for you. And three, they're going to determine which college funding option is best. You might be a family that just needs to, go into a profile school, so maybe a MEC option or maybe a MYGA option if you don't have a lot of income to fund anything else, and you might be going to a state school or university. Or for that matter, you might have a lot of income. You think you might not qualify for financial aid. But that money that you had allocated that you're going to pay for school, you can still use that money to pay for school by using loans out of the policy so that way your kid can go to his dream college. So like I said before, contact your certified college planner to find out which option is best for you. Thank you.